Hey friends, Lucian here with the Bullish Bears team. This video is going to be about how to trade iron condors. So an iron condor is a credit spread type of strategy. So you're an options seller. And what you're doing is you're creating a combination of a call credit spread as well as a put credit spread, and you're putting them together so that you want price action to stay in a range. This is a neutral trading strategy. So if a stock is extremely bullish or bearish, or it's going in one direction or the other, you wouldn't necessarily want to put on an iron condor strategy. So you want to have an iron condor for when a stock is trading neutral or trading sideways. And that's the beauty of iron condors, is you can make money in sideways or neutral markets, and you don't have to be extremely directional one way or the other. So just like any credit spread strategy, you're an options seller. So you're selling the spread to an options buyer and you're collecting the premium. So as an options buyer, or actually an options seller, right? So as an options buyer, you want time in your, time is not in your favor. So time goes against you as a buyer. But as an options seller, time is on your side. So that's where you want the option to decay in value, because every day that goes by in an option, it loses its value, or its, extrinsic value. It's time decay. So as an option seller, when you're selling to somebody else, you want that option to decay in value. So when you're building a iron condor, what you're doing is you're building your strike prices above resistance levels and below support levels. So you want price to stay between your two short strikes. Short strikes are also known as anchor prices. So basically when you're doing, let's say, a call credit spread or a put credit spread, you're choosing the sell strike, right? So with a call credit spread, your sell strike or your anchor strike, you want price to stay below that at expiration. And with a put credit spread, your short strike or your anchor price, you want price to stay above it. So with a call credit spread, that is a bearish strategy. With a put credit spread, that is a bullish strategy. So when you put those two together with an iron condor, it's a neutral strategy. So you want price to stay below your call credit strike, so your short strike, that is the one you're selling near resistance, and then you want it to stay above the put credit strike, which is where the support level is. So you want price to stay in between those strike prices by expiration, and if they do, you get to collect the premium. So let's talk about a couple of the positives and negatives of iron condors, and then I'll show you how to place a real live iron condor trade. So the biggest benefit overall with an iron condor is that you can make money in a neutral or sideways market. So that's, again, with options in general, being able to make money in any market is fantastic, right? Because if you're just doing, regular stock trading, you have to be directional, right? So if you're going long on a stock in general and you're buying shares of a stock, you need that stock to go up. If you're going short, you need it to go down. So with options, in the world of options, there's so many different strategies, but what's great about them is that they allow you to make money in bullish markets, bearish markets, and also neutral markets. And that's the beauty of iron condors, is that you can make money when the market or the security trades sideways. One of the biggest downfalls is it requires high margin, right? So it requires more capital in your account. So if you have a smaller account under $5,000 or $10,000, each trade takes up more margin, so that just basically means you can't be in as many trades. If you have a bigger account, 25,000 or more, it's not as big of a deal. But if you have smaller accounts, it just takes a little bit while. It takes longer to grow your account because there's less trades that you can be in due to the margin requirements. So let's take a look at a real world example on how to place an iron condor trade. You'll see I'm in my Thinkorswim simulated account or paper account. A huge shout out to TD Ameritrade. They have a fantastic virtual program, which means, especially if you're new to any type of trading in the stock market, TD Ameritrade allows you to trade the market real time in a virtual account. So you don't have to use real money to practice. You can use a virtual account to practice. And especially when you get into these option strategies, they're a little bit complicated to learn at first. That's why it's important to practice, right? So you'll see right here, I have I'm logged into my Thinkorswim simulated platform. So I'll show you how to place a real trade. This is using my simulated account, but you'll be able to do this. What you're looking at my platform here is exactly how my real platform would look. So this is where you can practice again, iron condors, calls, puts, credit spreads, debit spreads, practice them in your virtual account. And then when you get comfortable, then you just slowly scale your way up in a real account. So with an iron condor, you want price to stay kind of sideways. It's been a little bit difficult, especially when making this video, to find sideways markets because it's 2020. It's either extremely volatile, bullish, or bearish. But just for this video, I'll show you just an example of looking at a sideways or finding strikes where if you wanted price to stay within an overall range. So let's take a look here at Citigroup. You'll see here is a previous peak level, very important level, right around that $62.50 level, right around, say, $62. And then you can see kind of some support right here. Again, you can do support levels down in these areas as well. Again, some, over in here as well. But I just want to bring your attention to these more thicker lines that I put here. So you'll see, what is this? 62, just say $63 and $47. So before I build the iron condor, let's take a step back and break it down. Remember, an iron condor is a combination of a call credit spread and a put credit spread. And what is a call credit spread and what is a put credit spread again? A call credit spread is a bearish strategy. So that means you want price to stay below a resistance level. A put credit spread is a bullish strategy. It means you want price to stay above a certain level. So before doing an iron condor, if I was to do a call credit spread, let's say I just chose directionally and I believed price was going to stay below 62.50, I could do a call credit spread, let's say around $63 with my short striker at, let's say, $63. And by expiration, I'd want price to stay below that $63 short strike or my anchor price. On the flip side, if I was doing a put credit spread and I was bullish on Citigroup, I'd want price to stay above that $60 or $46, $47 range. So I'd want price at expiration to be above that $47, right? So that's if I was choosing a direction, whether I'm bullish or bearish. If I was bullish, I'd be doing a put credit spread. If I was bearish, I'd be doing a call credit spread. So with an iron condor, you're just taking those two strategies and putting them together in one trade and basically saying, instead of choosing an actual direction, bullish or bearish, you want price to stay below the short strike of, let's say, $63 and above that $47. So price can stay sideways. It can go up and break above and come back down. It could fall below. As long as it comes back up, you want it to be below or in between these two short strikes at expiration so you can collect the premium. So now I'm going to show you how to build an iron condor trade and how to place that trade. Now, I'm going to give you kind of a rough way to do it, like meaning just kind of an overall on how to do it. If you want to know specific strikes, the strategies, what to really look for when you implement an iron condor, make sure you upgrade to our yearly membership. When you're a yearly member, you get access to our next level training library where we break down pretty much everything: iron condors, credit spreads, debit spreads, what to look for, strikes, specific strikes, all that good stuff. So with this video right here, this is going to be more of a highlight on how you do it. But if you want more of the specifics, make sure you get access to our next level library. So what you want to do right over here is you would go over to the trade tab, and you'll see I'm going to look at right over here was the 62.25 and 47. So we're going to look at a rough range on how to build this trade, right? So I'm going to start over here and I'll look, I'll just look at around 49 days out, and then I'll look at the 65 strike and also the 40 over here. So if you're using the Thinkorswim platform, every platform is different, but if you're using Thinkorswim, you can right-click, click on Sell, and then you'll see right over here, Iron Condor. And you'll see as this breaks down, you'll see there's 4 legs right over here. You're seeing a sell, a buy, a sell, a buy. So the sell areas are our short strikes or our anchors. So this is where we want price to stay in between. So right off the bat, I'll just leave it at 65 right here. And let's go to the sell strike down here. I'll do 40. Move that down over here. Right there. So then you look at right here, you want to have your strikes equal, right? So you can see right here, here's 2.5 width strikes, right? 60 and 67, but this is 40 and 60. That's not equal. Those are other types of strategies that you can do with options. With an Iron Condor, you want them equal. So right here, you'll see I sold the 65 and then bought the 67.50. Now I'm selling the 40, so I want this equal a distance. So that's where I would go to, let's say 40 or 30, what is it? 37.50, I think. So let's go down to right over here. And so this is where you can see this is equal distance in these strikes. So 250 strike width, right? So with the selling of the 65, that means by expiration date, I want price to stay below 65 and I want price to stay above $40. So as long as price stays below 65 and above $40, I would collect this entire premium right here. So you'll see if I put it right here, that's 32 bucks, right? Again, you can change your strike prices. So if you want to receive more credit, you can see right over in here, if I change this from 65 up to, let's say, 70 and went instead of 250 strike width, if I made them $5 width, now you can see right here, the credit goes up, right? With the credit going up, obviously more risk, more max loss. But again, don't let the max loss scare you overall. You don't want to let yourself get to those max losses. Just like with anything along the way, you want to take your profits along the way, but also keep your losses small. So if a trade goes against you, keep your losses small. So that's, one way to kind of build it right here. So you can kind of widen your strikes, receive more credit. So I can go 65 to, let's say, 75 right over here. I can go 40 down to 30. And now, again, receive more credit when I open it up right here. Again, just widening the strikes, receives more credit, also increases the losses. You could also come in a little bit closer too. You can do something, let's say, like I can go instead of the 65, I could look at maybe the 60 strike if I wanted to come in a little bit closer and sell, where is it here? Iron Condor. I could do the 60, let's say 65 and sell the 45 right down over here. And then the 40 right down here. So here's one where I could receive, let's say, $23 credit, max loss 37. Again, you got to find, don't just randomly putting them on. Don't randomly put these trades on. Again, our next level library tells you the strikes to look at, the different strategies. We break it all down in our next level library. But for the sake of this video, let's just go with this one right here. You can see right here, we have 5 width strikes. We're selling the 60, so we want price to stay below 60 and above 45. If at expiration, it stays between $45 to $60, we keep the whole $123. Now remember, that's if at expiration we held. You want to sell your spreads before expiration and sell right around that, Again, there's no hard rule, but when you're around that 50% of profit level, take your profits. So that's how you can increase your odds of success on the trade, is not holding until expiration. So, like I came in on these strikes a little bit. So coming in on the strikes or the resistance level, I wanted it to be below, let's say, that 63 level. Well, if I brought it in at 60 and I took my profits, let's say around 50% or so, I can increase my odds of success. But again, I can't stress enough, you don't place any trade blindly. You have to know the technicals, you have to know support, resistance, all that good stuff. That's the stuff we teach you in our community each day and also in our courses and Next Level Library. So for the sake of this video, just to kind of keep it short and sweet, this is how you build an iron condor. And how you place the trade, we'll just put it out. I'll click send and place it out to the market. And typically it'll take a couple minutes or so, or a few seconds, sometimes a couple minutes, depending with TD Ameritrade. Sometimes they fill quicker than others. Again, this is my virtual account. Usually they fill it quicker, but you can see right up here, as it's waiting to fill and it's working the order, you can see it up over here. So if you want to adjust, your order, again, this looks exactly the way it would look in the real world. It just shows simulated here instead of real. All you would do is, there it goes and filled. If it was still waiting to fill, I could cancel, replace the order, and work the order and change the limit up and down. So now I want you to see what this looks like in your brokerage account and how it'll look in what it looks like real time, right? So you'll see right here, here's my position here, but here's where, when I open it, you'll see the combination right here. The 4 legs right over here. It's again a call credit spread and a put credit spread. You can see them over here and how it just kind of moves up and down in real market time, right? So that's what the position looks like. You can open it up right here. You can see it move up and down. And just kind of watch. It kind of just moves up and down, depending on how fast or what's going on in the market, volatility. I'm making this video on a Friday right now. It's a little bit slower of a day. It's the day after Thanksgiving, but you'll see that's how it just kind of moves up and down. So if you want to close your iron condor, very simple. You just come over here while it's collapsed right here. It's open here. Just collapse it. Right click on create closing order. And then just look at this one here. Don't look all the way down here. You're buying the iron condor back. Buying them down here, that's different strategies that we teach. But just to close out your iron condor and even it out, just click this top one right here. And this will bring it back over here. Again, you can work your order. Don't rush it. But for the sake of this video, I'm just going to go and I'm going to confirm and send it. You just confirm your order box right here. Send it in. And then, let the order fill. You'll see it's up here. It's waiting to be filled. So that's where I was showing again. If I go to cancel, replace, I could work it or try to get it filled a little bit quicker. But we'll just let this fill. I just want you to see what it looks like in real time. Let's just replace it, and I'll just do market just so you can see it fill quicker. Send it to the market. And then typically that'll usually fill quicker right here. Now again, don't just jump and send market orders out there. If you need to get something filled really quickly, then you can do it. Again, highly liquid stocks, not so bad, but practice sticking with those limit orders. But for this video, I wanted to show you how it fills quicker. And as you can see now, when I open this position, I no longer have my iron condor position. So that's how simple it is to build an iron condor. Again, you want price to stay below or above, above and below your short strikes. Again, it's a combination of a call credit spread and a put credit spread. And if you want to know how to do more of this stuff, again, we have our options courses that you can take, as well as our Next Level Library, which teach you all the different strikes. And we also have trade rooms where we go over this stuff and teach it live every day. So hopefully this video on iron condors helped you, and I'll see you in our community. Enjoy.